Welcome back to the deep dive. You're here because you really want to make smart money decisions.
Right.
But sometimes it feels like you're drowning in information. You just
Yeah.
get overwhelmed.
It can be a lot.
And one question I'm pretty sure has crossed everyone's mind at some point. Can you time the stock market? And even more importantly, should you?
Yeah, it's like this idea, you see it in movies, you hear people talking about it. Buy low, sell high.
Right.
Sounds so simple.
It does.
But we've been digging into this. And what we're finding when you look at the hard data is that chasing that perfect timing, that's actually a huge risk.
Mm-hmm.
And it could really hurt your long-term success as an investor.
So we are going deep. We've got a report here called Missing Big by Missing Small Note on Risk of Market Timing. And they've analyzed years and years worth of data from the Nifty 500 index. And what we want to do today is make sure you really understand why trying to dodge those market dips could actually make you miss the gains you really need for long-term growth.
Mm-hmm.
So I think we got to start with the basics here.
Yep.
We're talking about market corrections. And, the report really points this out, that corrections, there aren't these rare events. They happen way more than people realize.
Oh, absolutely. I mean, when you look at the data for the Nifty 500, and we're talking 2000 to 2024, that's a good chunk of time. These corrections, or what we often call drawdowns, they happen every single year. It's part of how the market works. And it's not always like these huge dramatic crashes.
Right.
Sometimes it's more like, the market's kind of just moving sideways for a while. We call that a time correction.
Yeah.
But even that can still, hurt you because you're not making gains that you could be making elsewhere.
And it's funny because when you see the numbers laid out like this, it really kind of hits home. I mean, on average, these corrections, they cause a 28.5% dip in the market.
Yeah.
That's significant.
It is.
And over that 25 years, falls of over 15%, they happen almost half the time, 48%. That's a lot of volatility that people are trying to avoid.
Yeah. And I get it. Nobody likes to see their portfolio, going down.
Right.
But here's the thing that I think is really important for your listeners. Even with all those dips, all that volatility, the market actually finished the year positive 80% of the time.
Wow.
So 4 out of 5 years, positive. And the average yearly change, over 19%, 19.2 to be exact.
So even with those drops, it's like you're driving down a road and you hit those speed bumps, but overall you're still moving forward. You're getting to your destination. And the report makes a really good point, adding to your investments during these corrections.
Yeah.
That's actually smart for the long run because you're basically getting more for your money.
That's it. Exactly. It's like things are on sale, right? And who doesn't love a sale? You're buying more units, more shares at a lower price. And then when the market bounces back, well, you're set up for some potentially bigger gains. So yeah, it's counterintuitive, I know, but it can really pay off in the long run.
It's hard though when you hear all this talk about the market going up, going down. People naturally want to time it.
Right.
They want to avoid the falls and catch the rises.
Oh, I get it.
Yeah.
I mean, it's this very appealing idea.
It does.
Right? Like you perfectly predict everything.
Yeah.
You sidestep the dips. You jump back in right at the bottom.
It's like the holy grail of investing.
It's like the ultimate dream. And the report actually acknowledges, that a lot of people, a lot of investors, a lot of traders, they try this, right? They're trying to kind of juice the returns a little bit. And look, it sounds so easy when you just, you explain it simply, right?
Right.
Buy low, sell high.
Yeah.
But the problem is, while the idea is simple, actually doing it successfully, consistently over time, that's where the real challenge comes in. It's just so incredibly difficult to do.
Because it's not about getting lucky once or twice, right?
Yeah.
You have to be able to do this over and over again, outperform the market consistently.
And that's really what market timing boils down to, right? You're trying to beat the market, achieve returns that are higher than what the market naturally delivers. And that's the real risk here, right?
Right.
Trying to avoid those downs. Because what happens when you try and avoid those downs?
You miss the ups.
You miss the ups. And that's really what we want to drive home here today.
Yeah.
It's this idea that a huge chunk of your long-term gains comes from just a few really, really good days in the market, or even weeks or months, right?
Yeah.
And that's really the central point that this report is making. So to illustrate this, they looked at the Nifty 500 data over a 20-year period, 2005 to 2024.
Okay.
That's almost 5,000 trading sessions.
Wow.
A lot of days.
Yeah.
And the results are pretty eye-opening. So if you had simply stayed invested in the Nifty 500 for that entire 20 years, your investment would have grown 15.7 times.
15 times.
15.7.
That's huge.
That's huge, right? That translates to an average annual growth rate, what we call the CAGR, of 14.8%.
Okay.
So on average, every year for 20 years, your investment grew by almost 15%.
I mean, if you can get that consistently, that's amazing.
Absolutely. Just to put that in real terms, if you had invested, say, 5 lakhs back in 2005, by the end of 2024, that would grown to almost 79 lakhs, 78.7 lakhs to be precise.
So you can see why staying invested is so powerful. But let's flip the script. What if you miss some of those really good days?
Yeah, because nobody's perfect.
Right.
And nobody can time the 100 perfectly.
Yeah.
So let's say you missed just the 20 best days over that entire 20-year period. 20 days out of, almost 5,000.
That doesn't sound like a lot.
Doesn't sound like a lot, but the CAGR plummets to 7.9%.
Oh, wow.
Your 5 lakhs only grows to about 23 lakhs.
So missing just 20 days out of thousands, and your returns are cut by more than half.
Yeah, it's a huge difference. And the report, they break it down even further. They highlight that those 20 best days account for about 71% of the total value created over that entire period.
That's wild. 71% of your gains come from just 20 days.
And it doesn't stop there.
Mm-hmm.
So let's say you missed even fewer of the best days.
Okay.
If you missed, say, the top 5 best days, your growth drops to 10.4 times. You missed 10 of the best days, it's down to 7.7 times.
And it keeps going down from there.
And it keeps going down. 30 best days, you're at just 4.6 times your initial investment. And if you somehow manage to miss the 50 best days, your money barely grows at all, just 1.5 times the initial amount.
So basically, all the growth is concentrated in such a small number of days.
Yeah, it's really remarkable when you see it laid out like that. And remember, we haven't even factored in things like transaction costs or taxes.
Right, because every time you buy and sell, that's eating into your profits.
Absolutely.
Yeah.
Those costs would just make the impact of missing those best days even worse.
So the takeaway is it's pretty clear. You miss even a few of those best days, and it can have a huge effect on your long-term returns. But what makes market timing so hard? Like in the real world, why is this so difficult to pull off?
Well, the report gets into something that's pretty counterintuitive about when these best days actually happen.
Okay.
You might think, oh, the best days are probably going to be during these periods of like strong, steady growth, right?
Yeah.
But the data actually shows something completely different. A lot of those best days, they actually happen during or right after these big market corrections. Those drops of over 15% we were talking about earlier.
So you're saying like the times when investors might feel the most scared, those are actually when some of the biggest gains are happening.
It's wild, isn't it? I mean, you would think, oh, I've got to get out now. This is, the market's crashing.
Yeah.
But historically, those times are often followed by some of the biggest surges upward.
It's like a roller coaster. You're going down and you're bracing yourself, and then suddenly, whoosh, you're shooting back up.
And that's exactly what the data shows.
Mm-hmm.
Between 2005 and 2024, 18 out of the 20 best days, that's 90%, happened when the market was in a correction, down more than 15% from its recent high. And if you look at the top 50 best days, 41 of them, 82%, happened during these corrections.
So trying to avoid those corrections means you're way more likely to miss out on those big rebounds.
Yeah, you're almost guaranteeing it.
It's a catch-22.
It really is. And it just shows how hard it is to time the market. I mean, you not only have to predict the downturn accurately,
Right.
you also have to know exactly when to get back in.
And it's not just about missing the worst days and catching the best. It's the timing itself.
Exactly. And that's incredibly difficult because the data shows that the best and worst days can happen super close together. Like we're talking days apart. Yeah. I mean, volatility, it often comes in these clusters. The data shows that some of the best and worst 50 days, they occurred within just 5 trading sessions, 45.5% of the time.
5 days.
5 days.
That's a tiny window to try and hop in and out of.
And if you expand that to 30 trading sessions, it jumps to 81%. So 8 out of 10 times, these huge swings are happening within a month of each other.
So to try and, guess when to buy and sell, to do that within a month, that seems like it would be basically impossible.
It's like trying to catch lightning in a bottle.
Yeah.
It's just not realistic. And it's not just the actual mechanics of timing. It's also the psychology.
Of course.
The human element.
Yeah.
That plays a huge role here. So the report highlights another big hurdle, and this is one that I think a lot of people can relate to.
What's that?
So on average, 5 to 7 out of every 10 trading sessions right before those best days.
Okay.
They actually closed in the red.
So like the market looks bad
It looks bad.
right before it starts going up.
Exactly. So you're sitting there, your portfolio's maybe down a little bit, and your instinct is telling you, get out, sell, cut your losses.
Hmm.
But if you look at the data, historically, that's often the exact wrong thing to do.
That's tough to like fight against your gut instinct.
It is, but it just goes to show that trying to time the market based on short-term trends or your emotions, it's a recipe for disaster.
Now, this report doesn't just look at individual days, though, right? It also talks about the best weeks and even months.
Yeah, so far we've talked about those big gains happening on specific days.
Right.
But sometimes they can be spread out a little bit over a week or even a month. So they wanted to see, okay, what happens if you miss the best performing weeks?
Okay.
And remember, staying invested in the Nifty 500 from 2005 to 2024 gave you that 15.8 times growth.
Mm-hmm.
But if you miss just the top 20 weeks during that same period, that growth plummets to just 3.2 times.
Wow.
And the Kukiyar drops to 6.1%.
Missing just 20 weeks. That's huge.
It is. And those 20 best weeks, they accounted for almost 80%, 79% to be exact, of the total value created. So we see the same pattern here as with the best days, just on a slightly longer time scale.
It's almost like the principle's the same no matter if you're looking at days, weeks, or longer periods.
It is. And again, a lot of these best weeks, they happen during corrections. 70% of the best 20 weeks and 63% of the best 50 weeks occurred when the market was down more than 15%.
So even if you're thinking, okay, I'm going to try and time it, but I'm going to look at weeks instead of days, you're still facing that same challenge of potentially missing those big upturns that happen after a dip.
Exactly. You just can't get away from it. And the psychological aspect still just as hard. On average, the 5 weeks leading up to those best performing weeks, they ended negatively 57% of the time. So the market's either flat or even declining right before it has a great week.
And then the report even goes into what happens if you miss the best months of the year.
Yeah, because sometimes those big gains can really play out over a whole month. So they looked at the yearly returns of the Nifty 500 all the way back to 2005. And they looked at how much of that yearly return came from just the 2 best months of each year.
Okay.
And it turns out those best 2 months, on average, they contributed a whopping 18% to the overall yearly return.
That's a big chunk.
Yeah, it's a big chunk. So if you're sitting on the sidelines, for a couple of those best months, it can really make a difference to your overall gains.
Yeah, that makes sense.
And the report shows if you missed the single best month each year over those 20 years, your overall growth would have been significantly lower. And if you missed, say, the top 5 months total, your investment would have only grown 6.8 times.
Compared to over 15 times if you just stayed invested.
Exactly. And if you missed the top 10 best months, it's only 3.9 times growth.
So you're really leaving a lot of money on the table if you're not in the market for those key periods.
You are. And it just goes to show that staying in the game, even through those dips, is absolutely critical.
Now, the report also touches on what the kind of expert consensus is on trying to time the market.
Yeah, because you hear a lot of different opinions out there.
Right.
So they acknowledge that a lot of people try to do this. They try to time it. But the question of whether you can consistently and successfully time the market over the long term, that's something that's heavily debated among financial professionals.
So even the pros disagree on this.
They do. And a lot of the experts, investment managers, researchers, they generally agree that it's incredibly difficult to do.
So if the people whose job it is to analyze markets are saying it's tough, that should probably give us pause before we try it ourselves.
Exactly. And it comes down to this, right? Getting it right a few times, that doesn't mean you've got a strategy. It doesn't mean you can replicate it.
Right.
Because as we've seen from the data, missing just a handful of those key periods can completely wipe out any gains you might have made from timing other moves correctly.
Okay, so if trying to time the market is so risky, what's a better way to go about this? What can we as investors do to build long-term wealth without trying to play this guessing game with the market?
Well, the report, it really emphasizes this idea of focusing on the long game.
Okay.
So think about your long-term goals.
Yeah.
Create an asset allocation that makes sense for you, for your risk tolerance.
Yeah.
And then stay invested.
Yeah.
Don't try to jump in and out. Don't try to time it.
Just write it out.
Write it out. Review your portfolio periodically. Make adjustments if you need to, but don't get caught up in the short-term noise.
So essentially you're saying accept the fact that there will be ups and downs.
Absolutely. They are a part of the journey. It's like driving a car, right? You're going to hit some bumps in the road, but you don't just stop the car and get out every time you hit a bump.
And I think, to sum it all up,
Yeah.
what we've really seen here is that missing even a small number of the market's best days, weeks, months, it has a huge impact on your returns over the long term.
It really does.
Right.
And the data is very clear on this. Those best gains, they often come right around when it feels the scariest to be invested, right after those market corrections.
It's like you said, that human element, those psychological biases, they really come into play. So I think that's something for all of us to think about.
Yeah.
When we get scared, when things look bad, do we run for the exits? And could that actually be costing us a lot of money in the long run?
It's a question worth asking yourself.
Yeah.
Are you so focused on avoiding those short-term losses that you're actually missing out on some really big long-term gains?
Right. So are we trying to miss small
Yeah.
and ending up missing big?
Exactly. And that's something we all need to think about, right?
Yeah.
Think about your own strategy, your own behavior. Really embrace that long-term perspective, because that's where the real magic happens.
And that is something to think about, right? Thanks for listening to The Deep Dive. We'll see you next time.
See you next time.